Hello, guys. Hope everybody's well. I wanted to talk about moving averages today and how to use moving averages if you're a long-term investor. So I know a lot of people that follow me are more long-term investors, but they always say they don't know when to buy or sell, even if they're long-term. So it's not to buy and hold forever kind of an investor, but this is more somebody that wants to keep it for 3 months, 6 months, 1 year, that type of thing. I'm going to show you a bunch of different examples. The chart I'm going to use and the time frame I'm going to use for all of these charts is the daily chart. Okay, so let's go through the daily chart for a bunch of different companies and show you what to look for. You go to the daily chart. TradingView is a good platform. It's free, it's simple, it's easy to use for most parts. And we're going to do backward-looking analysis on what might be the best time to have bought these things. Okay, so this is Apple. This is the one-day chart. Look at how, so there are four moving averages I've drawn here. The way to go to the moving averages, you click on indicator, and then you type EMA or you type SMA, 20 moving averages, and then immediately it shows up. And these are the moving averages. The red is the 20 moving average. This is the 50. This is the 100. This is the 200-day moving average. So go to indicators, add moving average. You can add simple moving average. You can add exponential moving average. The difference is simple is just the last. For example, SMA, simple moving average 20 years, take the last 20 prices divided by 20 and start drawing a graph from there. Exponential moving average takes into account more effectiveness for the prices most recent and less for the prices before. Okay, so you look at the 20-day moving average, you look at Apple stock. The interesting part is I want to show you two things. One is the 200-day moving average. This is the blue line here. You can see that. Every time if you had bought Apple at the 200-day moving average, maybe even at the 200 moving average, you're not going to be too bad in this case. But every time Apple hits the 200-day moving average, you're good to go. This is a no-brainer decision. If Apple gets to 200-day moving average, just buy as much as you can because it immediately goes all the way up. On the daily chart, 200-day exponential moving average, 200 seems to be a good point. It's not a bad decision as well to even buy some at the 100-day moving average, just to give you that context, right? So sometimes when it touches 100-day moving average, seems to move up as well. It doesn't move all the way to the 200-day moving average. But if it gets to the 200, there's a little bit of downside, but it's not going to go down all that much. For example, the 200-day moving average lumber here was 171. Apple stock went to 166, so $4. That's literally nothing, right? Look at it in the second situation. 200-day moving average was 171. It went down to 167, literally nothing again. So when Apple gets to 200-day moving average, buy on the daily chart. Let's look at Microsoft now, just to show you another context. Okay, so Microsoft stock, again, daily chart. Microsoft only once in the last 1 year has come towards close, moved below the 200-day moving average. And here, it almost came to the 200-day moving average at the 300 mark, 311 mark. The 200-day moving average is 305. So when in Microsoft case, the moment it comes to the 100-day moving average, there's very little downside for the stock after that. It's never really breached the 200-day moving average so far, except for once or twice. This was the beginning of the year in March. And look at this. This was bad. So in a market that most people are saying is trending upward, man, every day stocks are going up and to the right. We're in a bull market. Wait for the 200-day moving average. It will give you a chance. Let's look at the next stock, just to give you a little bit more context around which of these stocks actually makes a lot of sense. Google. Again, go back to the daily chart, draw your moving averages, look at the 200-day moving average. The moment it comes to the 200-day moving average, it bumps up. It hasn't even come to the 200-day moving average. Look at this. It's been close to the moving average 200-day. Buy it. This is the only time between January and March where it fell way below the moving averages. So let's look at that context for a longer time frame. If you're one of those that is looking for a longer time frame, when you are over, that if it is below the 200-day moving average, the stock is in a slump. So the moment it goes beyond below the 200-day moving average, don't touch the stock. Just don't buy it. Buy it when it moves to the 200-day moving average. And every time it comes back to the 200-day moving average, buy some more. It's a simple heuristic. You don't have to use too much thinking around this. Let's look at Amazon as the same example. This is the daily chart of Amazon, and I'm showing you the four different moving averages, the exponential moving averages of 20, 50, 100, and 200. I'm going to remove all of my numbers. So look at this. When it comes to the 200-day, little bit below the 200-day moving average, and off it goes. Amazon, unfortunately, for most of last year had been under the 200-day moving average. So when it gets to the 200-day moving average, if it is below the two, so here's a rule that you can apply. Below the 200-day moving average, just don't touch it. It's going to go lower and lower and lower. When it gets to the 200-day moving average on the up, let it buy. Buy it, keep holding it. When it comes back to the 200-day moving average, buy again, and it goes back again. I'm showing you 4 stocks. I'm going to show this for you for a few more stocks, just to give you a little bit more context how this works. It's a simple strategy. It's not too complicated. It's rule-based. It's consistent with the rule. Nvidia hasn't even given you a chance in the 200-day moving average except in January. After that, every time it comes to the 20-day moving average, buy some. 20-day moving average, buy some. Maybe 50-day moving average. Once it's come to the 100-day moving average, buy some, right? Let's look at the longer-term time frame for Nvidia. What has happened? Again, if the market is in a tough bear kind of a phase, the stock prices are going to be below the daily 200-day moving average on the daily chart, right? Don't buy it then. But if it is above the moving average 200-day, every time it comes to the 100-day, 200-day moving average, see how well Nvidia has also performed. You buy it at the 200-day moving average, you're not going to go too wrong. Okay, let's look at another stock. We're going to look at Meta now. How has Meta performed on the moving averages, and when is a good time for you to buy these stocks? Meta, the big magnificent seven, as they call them. I'm going through all of those stocks just to give you a little bit of a better context for it. Meta this year hasn't even given you a chance, hasn't given you a chance. So 100-day moving average, that's about it. It was below the 200-day moving average for quite some time, caught up to the 200-day moving average on this gap up. This was in February, and then after the races. The only time it has even come close is to the 100-day moving average. Okay, so the market is trending up. Look for a pullback to the 100-day moving average. Buy then, it keeps going. Now, you may think, okay, that makes sense only if you know what's going to happen in the future. You never know what's going to happen in the future. But if you're a long-term investor, you don't go too wrong by buying at the 100-day or the 200-day moving average. If you come to the 200-day moving average, buy a lot. Now, if you know that the market has been, so how would you make the decision? Let's look at this. You're holding Meta stock. And this is, we are right now at the 2021 December timeframe. And the stock has been moving down. It's below the moving average. Don't touch it. Just don't touch it. Wait for it. Wait for it. Wait for it. It's okay. Wait for it. Wait for it. It's going up above the moving average, 200-day moving average. All right, we're going to buy it somewhere in this time frame. We wouldn't have been wrong buying it. And then after the races, she goes. All right. Thank you very much for watching. Let me know what you think. Moving averages are very effective, very useful. And if you comment and let me know when you're using it, I'd love to be able to respond.